Welcome back. We're talking to legendary investor Howard Marks. He's founder and CEO of Oaktree Capital. And Howard, quite famously, you don't believe in big picture forecasts.
Exactly.
But this has been a couple of years where events have happened that nobody would have foreseen. The global pandemic, the war in Ukraine. We could list a bunch of others, the supply chain snarls that then ensued. What should people think about those unforeseen events? How do we deal with things that are really, really beyond our control?
I think if something's beyond your control, you should accept that. Mark Twain said, it's not what you don't know that gets you into trouble. It's what you know for certain that just ain't true.
Right.
And if you're ignorant about something, as most of us are, nobody foresaw the pandemic or the success of the recovery or the Ukraine. Then the greatest thing is to say, I don't know. It's very cleansing to say, I don't know, as opposed to trying to know the unknowable and toiling under that burden and being uncomfortable with your stance in the market.
Mm-hmm. Most of us can do that. How does somebody like you do that? In the sense that you do have to make investing decisions and you don't know. On a more micro level, for most of us, it would be, is this the year to buy a house, even though home prices are still high and rates are going up? What do we do about things that feel beyond our control, but we still have to act?
Well, again, I would not make that action based on some guess about the future. Do you like the house? Is it in a good location? Can you afford it? If your financial circumstances get a little worse, can you still afford it? That last question is really important.
Right.
You must prepare. I think you don't have to prepare for good times. You have to prepare for bad times. And then if the good times come, then you get some pleasant surprises. But we say we try to arrange our portfolio so the surprises are on the upside. We don't do things that based on an assumption of macro, big picture optimism. We take a conservative view, and then if things turn out optimistic instead, guess what? We get a bonus. But we all have to, I, and your watchers have to prepare for the tough times. I always try to remind people about the person who was 6 feet tall and drowned crossing the stream that was 5 feet deep on average. It's not sufficient to think about surviving on average. We have to survive the tough times. And we should all arrange our finances so we can do that at minimum.
Howard, it's so good to have you here with us. We appreciate your time.
My pleasure to be here.
Howard Marks is co-founder and co-chair of Oaktree Capital Management. Time for the takeaway, and when accepted wisdom should be rejected. If there's a lesson that non-expert investors have had drummed into us, it's not to time the market. Your investment portfolio is like a bar of soap, we're told, so every time you touch it, it may shrink. If we're lucky enough to put some money into stocks, we're told to leave it there for the long term. And that works until it doesn't. Every now and then, the rules of the game change, or perhaps not the rules so much as the terms of play. When borrowing costs are low, money flows easily. Businesses can get it, consumers can get it, and governments can get it and print it with abandon. When borrowing costs not only stay low, but only ever seem to get lower, it's easy to get used to that. But when it changes and money becomes pricier, the effect is harsh. Debt servicing costs soar, as many mortgage holders have found, forcing households to make tough decisions about where to spend. Businesses will find it harder to borrow, and publicly traded stocks may suffer, both because the underlying businesses can access less capital and because people need their cash for other things, so may sell stocks. That can be a short, sharp period before it reverts back to where it was. But what if the past few decades of low rates was the exception, and the decades of higher rates before that the norm? If we're at a time of change and low rates simply reset at higher levels, we would be wise to reconsider our actions. That mortgage we can't afford right now might stay this expensive. Stocks, which seemed less risky in recent years, only ever rising over time, may remind us that there are down times too. And boring investments like bonds, which we've ignored for years, could become exciting again. My takeaway? Sometimes it's a great idea to put some investments in place and look away. But this isn't one of those times. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.